Hi, I'm Keely from Retirement Dreams to Reality, and today I'm going to do a video about that grey area of retirement. So what is the grey area of retirement? Well, it's that period where you're not fully retired and you're not fully working. So yesterday I filled in the 18-page form to claim one of my defined benefits local government pensions. So you can have a little look at that now. The form wasn't too bad. I think it took me about 20 minutes. So that's the first thing. I need my national insurance number. It's not called a wage slip, it's called a pay slip. The pension folder reference number is not on the pension letter. Oh, it says on top of the accompanying letter. It's absolutely not. The pension reference with all of that information out of this whole letter, it's a tiny bit. And then you have to keep putting your reference number on the top of every page. Then it wants your national insurance number again. There seems to be a lot of information about additional voluntary contributions. They want my national insurance number again. Your death grant nomination form must be signed by other than the nominee. So if I'm leaving my pension to Bruce, Bruce can't sign it. The form asks for a bank paying in slip. So that's taken about 20 minutes. The pension that I'm drawing from only makes me £125 a month. But it is going to give me a lump sum of about £5,000. That's going to help with the shortfall of my first year. And that is why I'm doing this video. So I'm neither fully retired or fully working. I'm doing both. It's not as simple as just getting your income from your wage. And it's not as simple as just getting your income from your pension. There are actually so many more things that I've got to consider that I wouldn't have to consider if I was either fully working or if I was fully retired. So in terms of tax implications, obviously everyone has this tax-free allowance of 12,570. So I want to make sure that I'm utilising that. And remember that you get a tax-free lump sum with a lot of pensions, and that's what I'll be getting. Even more complex are these pension rules. So basically, if you are claiming a pension and paying into a pension at the same time, they do have certain criteria. I will be paying into something called the People's Pension. So that means I need to be quite mindful in terms of these strict rules. So you can see that this grey area of retirement, while you're still working and contributing to a pension, whilst taking from a pension, can get quite complicated. So what things am I going to have to do in this next year whilst I'm in this grey area of retirement? So the first thing I've got to try and work out quite specifically is exactly how much I am going to earn between now and April next year. Then I'm going to have to work out the shortfall from sort of my average current wage prior to this year. I've got to deduct my defined benefits pension. Then I've got to work out what is left from my personal allowance. So when I've added all those things up together, how much is left out of that 12,570 personal allowance? And then once I've worked that out, then that gives me the really important decision of where to get the rest of my money from. And then I'm going to take the remainder that's required from my Invest Engine ISA, which is tax-free. But I'm going to have to do all of those things whilst trying to make sure that my withdrawals from my ISA and my SIP aren't too high and don't sort of break away from recommended withdrawal rates. That's only until April. I won't know really if I've done that right until the end of the tax year. And then it'll be fingers crossed and hope that I get a rebate for my tax-free lump sum rather than end up a big tax bill at the end. I mean, luckily, it's small amounts of money, and luckily, it's only for a few months. And I just thought this was a good video to do to illustrate it's not simple. Retirement and pensions are not simple. I was listening to a podcast by Pete Matthew and Roger Weeks, where they were talking about somebody who took a considerable lump sum from their personal pension and then wanted to pay a considerable lump sum into their pension. And there were something like 5 questions.
But essentially there are 5 questions, right? And they're all yes or no answers. Mm-hmm. So let's try and do this. Okay, so if I ask the questions, you happy to see if you can?
I'll try, yeah.
Right, so the first question, Phil, is has the individual received or are they planning to take a tax-free cash lump sum? Question 2, is the amount received over 12 months, this is amount of tax-free cash, more than £7,500? Question 3, as a result, have contributions increased by more than 30% of what might have been expected? Question 4 is, are the additional contributions more than 30% of the tax-free lump sum received? And the last question is the recycling pre-planned?
Sort of got you to answer to say whether you were allowed to do that and claim the tax relief back. And the take that I took from it was, one was intention. So if when you took out of your pension, you intended to then put it back into another pension, then that's a massive no-no because you can't claim your tax relief twice. So intention was big, but the other big thing was this 30%. So whatever you take out of a pension, when you're putting back in, it shouldn't be more than 30% of what you took out. So I thought that was a really interesting point as well. So even though I might sound a little bit overwhelmed by all of this and it all sounds really complicated, I'm still actually really, really excited that that letter has gone off and I am starting to draw my pension from the 1st of January 2026. That's Keely from Retirement Dreams to Reality. Thanks for watching.